Assalamualaikum warahmatullahi wabarakatuh. In this occasion, I would like to share you about equity research. Here, I, founder of Blue Chip Capital, will recommend you to hold this emittance. What is this? It is a INDF, or we can call it Indofood Sukses Makmur. Indofood in manufacturer sector. And why I choose this stock and recommend you to hold this stock, I will share you after this, so don't miss it.
Okay, let's talk about equity research for PT Indofood Sukses Makmur Tbk. Here, company update in Monday, 17th of July 2019 by Blue Chip Capital. Okay, here the highlight: undervalued stock with good performance. We show the recommendation to hold for PT Indofood Sukses Makmur based on the stable of profitability, and INDF has CAGR 4.6% during the last 3 years. Okay, another highlight is mediocre profit growth in 2018. Here, the increase of profit just 4.6% during 2017 until 2018. After that, the PE ratio INDF versus competitor, the PE ratio INDF has lower than the competitor. It means the INDF has cheap price. After that, INDF has 4 core business such as Bogasari, CBP, agribusiness and distribution. Here, Bogasari and CBP improvement in sales growth, but agrobusiness and distribution margin not as good as previous years. So it means the mediocre profit growth in 2018. Here, the CBP is noodle production and Bogasari is flour production. Next, the recommendation is hold. Here the last price and here the target price. The potential upside 9.16%, and here the market profit 52 weeks high is 7,900, and here the 52 weeks low, and the beta is 1.2, and the dividend yield is 2.5%, and share outstanding is 8.78 billion, and the market cap more than 600,000 billion. Here the shareholder, the public, hold the stock for 49.9%. Okay, next. Here the table of current PE ratio. Okay, here the table of current PE ratio. There are many stock here. The violet line is INDF, and there is Mayora, ICBP, ULTG, and Kino. And here, as we know, the INDF PE ratio is 14.46. After that, this is an investment summary. Here, there is a INDF and index performance. INDF index, JKSE index is IHSG, reflect to the market, and JKMNFG is index of manufacturer. Here the all manufacturer sector reflect in this index. Okay, the figure 2 shows us that price of INDF tends to increase over time, but the volume of that stock is very volatile comparing with JKSE and the manufacturer index. But ENDF, the performance of ENDF is above the other benchmark. Okay, after we know about the investment summary, we talk about investment risks here. There are two investment risks. One is depreciation of rupiah, exchange rate risk, and the second is CPO price, the fluctuative of CPO price. Rupiah has depreciated since US gave signal of increasing Fed rate last time. There is a strong possibility that rupiah will increase more than 15,500. It will give impact for importer. PT Indofood, Sukses Makmur need CPO to production. When the rupiah depreciate, it can be affected to CPO price. So the CPO price is the second risk of this investment. And as we know, in 2019, the CPO price is declined. Okay, here we talk about business overview. For complementary strategic business group, Indofood has 4 core business. One is consumer branded products, second is Bogasari, and then agro business and distribution. And the main business activity, the flour milling industry, which itself is integrated with the company's subsidiary engaged in the field of consumer branded product. The agribusiness industry, which consists of oil palm plantation and related processing mills, as well as other types of plantation and processing operation, as well as distribution. Okay, here the Indofood brand product, there is Indomie, Supermie, Sarimi, Popmie, and others. Okay, why I say that ENDF has good performance? If we look at the net sales, since 2014 until 2018, the net sale always increase. After that, we talk about industry overview and competitive positioning. Using Porter 5 Watch model, we identify ENDF competitive positioning as follows. 1. Threat of new entrants is moderate, and bargaining power of customer is high. And then bargaining power of supplier is moderate. 4. Threat of substitute product is high because there are many competitors always show and always make new product with high innovation. Okay, the 5 is rivalry among industry is moderate. Okay, let's talk about financial analysis. 1. The company's revenue growth in 2018 is 4.6% year-on-year compared to revenue growth in 2017 is 5.1% year-on-year. The second is stock performance evaluation. Looking at the market performance, we see that the company has stable performance as well as manufacturer index and be able to perform better than the market. And then ENDF has good credit rating with ID AA+ by Pevindo. Here ENDF issue bond and Pevindo give a better rating for ENDF bond. Here is dividend paid by companies are based on its net income. ENDF divide the dividend based on net income, and in every year INDF share 50% 50% net income to shareholder. Okay, here the dividend policy of the company is to deliver cash dividend in respect to the net income in the year. The amount of dividend is 50% of net income based on the amount of net income for year. Okay, we can see here in 2018 the dividend per share is 236. Okay, this is the table of key ratio of INDF. First, the key ratio of financial health and efficiency and cash flow. As we know, in 2014 until 2018, the current ratio is increased, and all of the key ratio show that the INDF still has good performance for 5 years and still has positive net income. After that, the efficiency in what is that? Days sales outstanding. We can look at here. It's increased, but in 2017 to 2018 just decreased but not hike. Okay, we can see the cash flow here, and the cash flow is decreased since 2016 until 2018. The cash flow is decreased, but it's no problem. But INDF still has positive profit or positive net income. After that, we talk about the valuation. To evaluate company intrinsic value, we will use the discounted cash flow or DCF model, dividend growth model, and relative model, which is PE multiple. We use several methods of valuation to give more comprehensive and convincing result. First, I use discounted cash flow model or DCF model. Okay, the DCF model highlight 3 variables. One is capital expenditure, or we can call it CapEx. The capital expenditure of INDF will rise this year due to land acquisition. The targeted capital expenditure is 14% from last year CapEx. INDF is 12.9%. Okay. The second is WACC, weighted average cost of capital. We obtain the risk-free rate from 10 years Indonesian government bond and the market return from JKSE or IHSG geometric mean for 9 years is 9.16%. Lastly, we calculate beta is 1.13%, 1.13, and then cost of debt obtained from government bond at 8.7%, and after tax cost of debt is 6.53%. And with this assumption, the weighted average cost of capital for INDF is 8.35%. Okay, after that the terminal value present the current value of all future value in time when growth rate is expected stable over time. Using real GDP growth, and the terminal growth rate is 2.05%. Here the DCF key variables. One is risk-free rate 7.12% and market risk premium 4.99%, and the beta is 1.13, cost of equity 12.74%, and market value of equity. And here the DCF key variable, and then the dividend payment in 2018 here. After that, the highlight is the required rate of return is 12%. Based on DCF model, the fair price of INDF is here. So the current stock value is cheap than the fair price. Okay, this is the second and the third tool to know the fair price of Indofood. The second is dividend growth model. We use Gordon growth model to determine the intrinsic value of a stock based on a future series of dividend that grow at constant rate. Okay, the growth rate of dividend is 8.7% based on the calculation, and the required rate of return at 12%. We find that the intrinsic value for INDF is 6,854, contrast to the current price here. So this is, or the stock is classified as undervalued. Okay, based on the price multiple relative model, the valuation will use the data of PER, EF per EBIT, PBV, profitability, and effectiveness ratio. We will also compare the company with the competitors, such as Mayora, Ultrajaya, and Garuda Food. The idea of this model is that the asset in this industry will behave the same. Okay, based on the price multiple, here we know the current valuation of INDF, Mayora, Indofood, Mayora, Garuda Food, and Ultrajaya. Here we can find the mean, median, high, and low. The market capital. As we know, Indofood has the highest market capital. And the second is PE ratio. The Indofood has a lower PE ratio than the competitors. It means the price of Indofood is undervalued or cheap. And then the earning yield of Indofood is higher than others. Price book value Indofood is lower than other. It means the price of Indofood is undervalued or cheap. And then here the current valuation of profitability. And then the ROA of Indofood still the lower than another, and then the ROA is the lower too, and then the return capital employee Indofood just have lower return, but the stock is cheap, so I recommend you to hold this stock because it can upside but not significant. Okay everyone, the last one is risk analysis. In managing the business activities, there are risks linked to each operational activity. The board of directors will be responsible to identify and evaluate the company exposure to risk and manage it. So, here there are two risks. First, the one is the business risk, and the second is financial risk. Here, the business risk, one is supply of raw material. When the company is difficult to get the raw materials, the company should store the raw material in their inventory on average over 3 months. And then the second, when there is risk in foreign exchange rate, the manager should forward exchange contract transaction to manage risk. And then the third is distributor and customer relation. When the relation is not good, the manager should make long-term agreement is made as the proof good intention. And then the risk of commodity price volatile. Here Indofood should be careful with the price of CPO because the CPO the price is volatile. And then the last one is regulatory change. After that, financial risk. There is three in financial risk: market risk, credit risk, and liquidity risk. And the Indofood should be careful about this. But in credit risk, there is no significant concentration of credit risk in this company. Okay, that's all my presentation, and I hope you understand about that. And I recommend you to be a good investor. You should know about fundamental and technical analysis to choose the best stock in your portfolio. Okay, see you.
Thanks for watching and see you again.